Hey, managerial accounting students, I'm glad that you're joining me for Chapter 5. Chapter 5 is a really important one, cost volume profit relationships, or what we call CVP for short. We're going to put together some concepts about cost behavior that we've learned already this semester and use them to, predict how changes are going to affect our financial statements. So first, a few assumptions. To simplify CVP calculations, managers typically adopt the following assumptions. So remember, in managerial accounting, it's okay to make some assumptions. We're more concerned with relevance and timeliness than we are with precision. So number one, selling price is constant. So we can choose to make changes to the price, but overall the price of the product aren't going to change as volumes change. Or if you think about like gas prices, they change constantly, right? So we have to make the assumption that the selling price of our product is constant unless we make a management decision to change it. Number two, costs are linear and can be accurately divided into variable and fixed components. So you guys know how to divide costs into their variable and fixed components. And when we see a mixed cost, you know it's your job to break it into variable and fixed. The variable costs are constant per unit, and the fixed costs are constant over the in total over the entire relevant range. So we're assuming that we're operating within the relevant range. And then finally, number three, in multi-product companies, the mix of products, or what we call the sales mix, remains constant. So for most of this lecture, number three is kind of irrelevant. Then we'll talk about sales mix at the end. So we'll worry about that one at the end. So first, we're going to be looking at contribution margin and how changes in activity level are going to affect our contribution margin and net operating income. To be really honest with you, I think that the slides and the chapter kind of overcomplicate all of this. I'm going to try to really simplify it, and the answer to most everything that we need to know is going to come on these next two slides, and we're just going to learn how to apply that knowledge through the rest of the chapter material. So we're looking at this income statement, very basic income statement for Racing Bicycle Company. And we see we have sales of 500 bicycles, that's $250,000. So we could figure out the sales price per bicycle by dividing by 500, right? And then we've got our variable expenses at 150,000, our contribution margin, our CM, at 100,000. We subtract our fixed expenses of 80,000, and we arrive at net operating income of 20,000. Now, because we're using contribution format, we have arranged our expenses by their behavior, right? We've got variable up top and we've got fixed expenses toward the bottom. So we've arranged it based on cost behavior. The contribution income statement is helpful to managers in judging the impact on profits of changes in selling price, cost, or volume, the emphasis being on cost behavior. And again, the CM is the amount remaining from sales rev after variable expenses have been deducted. So we're familiar with this format, but what we're going to learn is how to use this as a powerful tool. So contribution margin is used first to cover fixed expenses. Any remaining contribution margin contributes to our net operating income. So we had enough contribution margin, we're at 100,000. We've got enough that we cover our fixed expenses, and we have $20,000 excess, which is our net operating income. So under this contribution approach, here's where we get to the key, the answer to the whole chapter. Sales, variable, and CM can also be expressed on a per unit basis. So over here, they told us that we've got 500 bicycles, right? These sales are 500 bicycles. So by dividing each of these figures, 250,000, 150,000, and 100,000, by dividing each of them by 500 units, we get a per unit amount. So that's where the 500, 300, and 200 come from. And that is powerful information there. So we're dividing the totals by the number of units. And so here's the thing. Each month, RBC must generate at least $80,000 in total contribution margin in order to break even. So that would just put us at zero, right? If our contribution margin came out to only 80,000. So to compute the break even, and this is kind of your answer to the chapter here. To compute your break even, you're going to take your fixed expenses, so that's the 80,000, right? And we divide it by our CM per unit. So what do you get if you take 80,000 divided by 200? I'm hoping you came up with 400, right? All right, so 400 bikes, that's the answer to really the rest of the chapter. Not literally, but if we think that way, our fixed divided by our CM per unit, that's going to give us our break-even point, which is 400 units. So here they show us, here's what happens to our income statement at 400 units. We take 400 bicycles times $500 per unit. Our new sales revenue would be $200,000. Our variable expenses are now $300 per unit times 400 units is $120,000, and our contribution margin is $200 per unit times 400 units is $80,000, which is just enough to cover the fixed expenses and leave us with net operating income at zero. Big shocker. So another way that we could do that faster is just take our contribution margin. We didn't have to do sales minus variable equals contribution margin. We know our CM per unit is 200, so we could just start there to verify our work. So $200 per unit times 400 units is 80,000. That covers our fixed, and we arrive at zero. So here's the thing. If we think of our profit relative to the break-even point, if I sell only 399 bikes, what's going to happen to my net operating income? My net operating income would go down by $200 per unit. If I sell only 399 bikes, then I'll be at a net operating loss of $200, so negative $200. If I sell one more bike, then my net operating income is going to go up by $200. So we can think of our net operating income in relation to our break-even point. So each time we don't have to prepare a new income statement necessarily. We can figure out, well, how many bikes, how many units am I over break-even or under break-even, and just multiply that by $200 per unit, our CM. So for example, if RBC sells 430 bikes, net operating income will be $6,000, and we can do that quickly. We'll just take 30 units above break-even times $200 per unit, which was our CM per unit, right? So 30 times 200 is 6,000. What if I sell 380 bikes? So now I would be 20 bikes below break even. So I'd take 20 times 200 and I would be at negative 4,000, right? You guys with me? So here they give us an equation to express what we've just learned. Profit equals sales minus variable, that's contribution margin, right? Minus fixed expenses. Now you probably never really thought of that as an equation before, but that's the income statement. Sales less variable expenses is our contribution margin, less fixed expenses equals our net operating income, our profit. So we probably already knew that. We just didn't think of it as an equation. That's just how the income statement works. So here they're pointing out that we can solve that same thing. 401 bikes is going to give us profit of 200, but I don't think we need this whole equation thing. If we know that the break-even point is 400 bikes, if we're one bike above break-even, then that's one bike times CM of 200 equals 200. If you want to do all the math and write the equation, then so be it. But I personally think it's overkill. If we keep going back to the beginning, break even is 400 bikes. If you know how to compute break even and you've got 400 bikes, then we can think of everything relative to that break even point. All right, so in equation form, they make this they break it down even further. So now profit equals P times Q, which is, well, selling price per unit times quantity, minus V times Q, which is our variable expense per unit times quantity. Well, then guess what? Then they're going to have us, we could probably take one of the Q's out of the parentheses, right? And then minus fixed expenses. Doesn't this all say the same thing? I think it does. So again, at 401 bikes, we can take 500 times 401 minus 300 times 401, which is really 500 minus 300, that's 200 times 401, minus 80,000 fixed. Guess what? It still equals 200. So again, I don't think that we need all of this. Here, they've rearranged it even further, right? It's our unit CM times quantity minus fixed. But I still just keep coming back to the same thing. It's one bike above break even, therefore it's 1 times 200, profit would equal $200. What if we're 5 bikes? What if we sell 405 bikes? Then we would take 5 bikes times 200 and we'd have a profit of 1,000. So I don't think we need all these fancy equations and formulas. If we just can think of our break-even point and how many bikes or how many units we are above or below break-even, we can solve pretty much anything. So we're going to look at the CVP graph and the profit graph. So here's our data, and again, this is for the same company, Racing Bicycle, and they have done their income statement, their contribution format income statement at a level of 0 bikes, so 0 units sold, 200 units sold, 400 units sold, and 600 units sold. So at 0 units sold, we just have our fixed expenses, 80,000. And that's always the name of the game. If we know what our fixed expenses are, we want to figure out how can we generate enough contribution margin to cover those fixed expenses and hopefully provide for some profit. Well, 200 bikes results in $100,000 in sales, $60,000 in variable expenses, and therefore contribution margin of $40,000. Now we could have just skipped straight to that point. 200 units times a CM of $200 per unit is 40,000, minus 80,000 fixed is minus 40,000. And I even could have just skipped straight to the bottom. 200 units sold is 200 units below our break-even of 400 bikes. So my profit is going to be negative 200 units below break-even, times our CM per unit of 200 would give me negative 40,000. At 400 bikes, we're at break-even, right? We've already seen this model. Sales is 200,000 minus variable is 120. Our CM comes out to exactly 80,000, exactly the fixed expenses, and therefore we have net operating income of 0. At 600 bikes, we're now 200 bikes above break-even. So I could just skip straight to the net operating income, 200 bikes above break-even, so we take 200 times our CM per unit of 200, and now I'm at plus 40,000. So that's our data. We're now going to turn that into a graph. So in a CVP graph, unit volume is going to be on the x-axis, the horizontal axis, and our dollars are going to be on the vertical axis, meaning the y-axis. So we start with our fixed expenses, so a straight line at 80,000. It doesn't matter if we sell 0 units or 600 units, our fixed costs are still 80,000. Then we're going to add in our line for our total expenses. So we're looking at our total expenses here. So the line intersects at 80,000 because even at 0, we still have fixed costs of 80,000. And then it slopes upward. Remember learning a little bit about slope, rise over run? So the variable expenses cause the line to slope upwards. So it intersects at 80,000, the fixed amount, and then it slopes upward at $300 per unit. Okay, remember our variable expense was $300 per unit. And then we're going to add in our sales line. That's the green line. So at 0 sales, we're at 0, right? So we start at 0, 0. And then when we sell 100 units, then we're at $50,000 in sales. At 200 units, we're at $100,000 in sales, and so on, right? Because the bikes are going to sell for $500 per unit. All right, so we draw that line. That's our green line. And what's cool about the CVP graph, I love a good CVP graph. I know that's kind of nerdy, but it's true. Where the blue and the green line intersect, where sales equal total expenses, of course, is at 400 units, our break even. So when sales are 200,000 and our total expenses, variable and fixed, are 200,000, we're of course at our break even point. And what we see up and to the right is what we call the profit area, and down and to the left is our loss area. And we could actually get into some fun trigonometry problems involving triangles and angles and all that, but we'll spare you on that. But I think this is a beautiful graph. I love how it shows our fixed at this red straight line. I love how the green and blue lines intersect at 400 units. So that's the CVP graph. You guys need to know what each of the lines represents and where they're going to intersect. Then we have the profit graph. So it's a little bit simpler than the CVP graph. We're simply just graphing the profit lines. Remember, profit equals unit CM times Q, the quantity, minus fixed costs. So they've just slapped that into a graph. So of course, at 400 bikes sold, look where we're at, 0. Okay, so we knew that would happen. So they're just graphing just the one profit line. There we are at break even. At 400 units, we're at 0. But what's important to see is that below 400 units, our profit is negative. It's below the 0 line. So next we're going to use the CM ratio to compute changes in contribution margin, net operating income based on changes in sales volume. Now, warning, this is going to seem somewhat repetitive as to what we already did. The break-even point is still 400 bikes. If we sell 401 bikes, the profit is still going to be 200. This is another way of computing the same thing. And I'll be honest, I like the first way of doing it. Just computing the break-even point in dollars, computing the break-even point in units, and then knowing our CM per unit. This, I think, unnecessarily complicates something that's very simple. So we're going to do it anyhow, and you can solve problems however you see fit. So you're going to choose the method that makes the most sense to you. This is just another method of doing the same thing. So our CM ratio is the CM divided by sales. Okay, so we're going to take $80,000 divided by 200,000 equals 40%. We also could have gotten that by taking 200 CM per unit divided by $500 of sales per unit. 200 over 500 is that same 40%. So whether we're doing it on a per unit basis or at a certain level of sales, doesn't matter, our CM ratio still comes out to 40%. So what this means for each dollar increase in sales, that's going to result in a total contribution margin increase of 40 cents because the other 60 cents are soaked up by variable expenses. So then we can use this. They're now showing the same math using the per unit numbers. $200 per unit divided by $500 per unit, we get 40%. Okay, we already knew that. So just another way of computing the exact same thing. And here they're showing the variable expense ratio. So they're basing this on, I think, 400 units of sales. They've got $120,000 in variable expenses divided by $200,000 of sales equals 60%. And again, we could have taken 300 of variable expenses per unit divided by $500 of sales per unit and come up with 60% just the same. Or they're pointing out, well, yeah, and you could also just do 1 minus 60% to get our CM ratio, or we could get our variable expense ratio by taking 1 minus 40%, and the other 60% is going to be our variable expenses. So here's the thing. If we know our sales per unit was 500 and our variable expenses are 300, therefore our CM is 200 per unit. They're just assigning percentages to those. I know I'm kind of writing over the top of things here, but this is 100% is our sales. 60% of that is variable expenses, leaving the other 40% as our CM ratio. So we're just expressing each number as a percentage of sales, with sales, of course, being 100%. Okay, so that's all we're talking about in terms of our CM ratio and our variable expense ratio. So then we can use that ratio to solve problems. So for example, if RBC increases sales from 400 bikes to 500 bikes, so that's an extra $50,000, right? Contribution margin is going to increase by 40% of 50,000, which is 20,000. And so they prove that in the form of an income statement. So we're taking 50,000 times our CM ratio of 40%, our net operating income goes up by 20,000. But guess what? There's another way of doing that. We sold 100 bikes more than break even. 100 bikes times $200 CM per unit is that same 20,000. So really, you can do it whichever way you prefer. If you like the ratios and the percentage, then by all means use it. If you just like to know the break-even point and the CM per unit, which that's my preference, then use that method. So we've got multiple ways of solving for the same thing, and you can choose to use whichever way you like. So here's an opportunity to do it the way you like. Coffee Klatch is an espresso stand in a downtown office building. The average selling price of a cup of coffee is $1.49. That sounds like a good deal. That's no Starbucks pricing, right? And the average variable expense per cup is 36 cents. The average fixed expense per month is $1,300. An average of 2,100 cups are sold each month. So plenty of info there. They want to know, what is the CM ratio for Coffee Klatch? Go ahead and hit pause for a second while you work this out. Grab a pencil, paper, and calculator. So I'm hoping that you came up with B. We're going to compute our unit contribution margin. So $1.49 selling price minus 36 cents. That's $1.13, right? So our CM per unit is $1.13, and we're going to divide that by our unit selling price, $1.49, and therefore our ratio, $1.13 divided by $1.49, is 0.758, or 75.8%. So that's our CM ratio. So next, here they're giving us more equations. We already know this. Profit equals, well, it's a different form this time, right? We already know the basic profit equation, but now they're putting in the CM ratio. So if we take profit equals CM ratio times sales minus fixed expenses, it's just another way of restating the equation we got previously. And look, we still come up with 20,000. So our profit equals the CM ratio, 40%, times the sales dollars, 250,000. So that's 100,000 minus 80,000 equals 20,000. Now that answer shouldn't shock you. Again, 500 bikes. We are 100 bikes over break even. And if I take 100 bikes over break even times $200 CM per unit, I get the same 20,000. Okay, so this shouldn't surprise us that we keep coming back to $20,000 profit based on 100 bikes over break even. Next, we're going to look at the effects on net operating income based on changes in variable costs, fixed costs, selling price, and volume. So essentially, we're going to tinker with all the parts of our income statement, all of our different inputs, and figure out what that's going to do. So try this one. You guys should have pencil, paper, and calculator at hand here. So we're looking at a change in our fixed costs and our sales volume. So what is the profit impact if RBC can increase our unit sales from 500 to 540 by increasing the monthly advertising budget 10,000? So we can draw out a whole new income statement comparing 500 units at our current scenario versus 540 units at this new scenario. But I think there's another way we could do it. So 40 extra units, how much CM is that going to generate? 40 more units. So I would take 40 more units times 200 CM per unit, right? And that equals what? 8,000? So is it a good idea to spend $10,000 in fixed advertising to make my CM go up by 8,000? No, what's the result? Minus 2,000, right? So this is a bad idea to spend 10,000 more to generate an extra $8,000 of CM. So I come up with minus 2,000. Here's how they do it. They drew out the income statement in full. So 500 units, we already have seen this income statement. That's sales of 250,000, variable expenses of 150. So we have a CM of 100,000 total minus fixed equals 20,000. So if we redo this under this new scenario, we're taking 540 units times 500 gives us sales of 270. 540 units times variable expenses of 300 per unit gives us variable expenses of 162 and therefore a CM of 108. We also could have just skipped straight to this point. We could have done 540 units times 200 equals 108 and subtract our fixed expenses, which have now gone up by 10,000. So now they're up to 90,000. So our new net operating income is 18,000, which is a decrease of 2,000, right? So I solved it a little bit different way rather than drawing out the full income statement. So here they're showing the way that I was thinking of it. And this is why I think just knowing our unit change and our CM per unit is so powerful. So we don't have to redraw the whole income statement. We can quickly solve problems using what they refer to as incremental analysis. And I think that's my preference. But again, this chapter is going to present a lot of ways to do the same thing. As long as we keep focused on how they want the answer, meaning in what form. Is it in dollars, or is it in units, or is it a increase or decrease relative to something else? If we can use these tools to problem solve and stay focused on what answer they're looking for, I think we can use these tools to solve pretty much anything. All right, so this time we're looking at changes in variable cost and sales volume. So if we're changing our variable cost, that's also going to change our CM per unit. So what is the profit impact if RBC can use higher quality raw materials, thus increasing our variable costs per unit by $10? So if variable cost per unit is going up, then our CM per unit is going to be going down by $10 per unit, to generate an increase in unit sales from 500 to 580. So our new CM per unit is now only going to be 190 per unit, okay? So this one is a little bit harder to use the incremental analysis method. Here's how we would solve it. We still have our original scenario at 500 units, $200,000 of operating income. If we redo this at 580 units, we could take 580 times 500. That gives us our sales of 290,000. Now our variable costs are 580 times 310, which gives us 179,800. And we subtract and we get our CM. Now we also could have just skipped straight to this point. We could have done 190 per unit times 580 units to compute this 110,200 minus 80,000, and we get our net operating income of 30,200, which is a significant increase, right? Our sales have increased by 40,000 and our net operating income increases by 10,200. How about this one? What is the profit impact if RBC, 1, cuts its selling price by $20 per unit, 2, increases its advertising budget by $15,000 per month, and 3, this causes sales to increase from $500 to $650, 500 to 650 units per month. So we're looking at all kinds of changes here, right? So again, incremental analysis might be tough in this situation, so we might want to draw out the income statement again. So they start again with the same info here under 500 units. So that stayed constant. So we're comparing our new scenario to that. So we've got 650 units times 480 now, because our selling price got cut from 500 per unit down to 480. So we've got sales of 312,000. Our variable expenses, we're going to stay the same, right? No change there. So that's $300 per unit. So 650 times 300 per unit. And then our contribution margin is 117,000. So another way that we could get that is we could just take our CM per unit. It used to be 200 per unit, but then our selling price went down by $20. So now our new CM per unit is 180. And if we take 650 units times 180, we should get 117,000. So if you want, you can just skip straight to this point without doing sales minus variable. Our fixed expenses have now gone up by 15,000. So we go from 80 up to 95, and our net operating income has gone up by 2,000, up to $22,000. So question, if you're the business owner, do you think making all these changes is a risk that you want to take in order to increase net operating income by $2,000? Reducing the selling price, spending an extra $15,000 in fixed costs with the belief that it's going to go from 500 units to 650 units. What if it doesn't? What if it doesn't increase quite that much? So we need to look at the risk that we're taking on here. I'm planting a seed towards something we're going to talk about toward the end of the chapter, which based on our cost behavior, there's risk in having fixed expenses. Based on our fixed expenses, we have to generate a certain amount of CM just to break even. So the higher the fixed expenses, the more we have to sell just to break even. So we need to consider our break even point as we do this. What if we have a bad year? Well, we'd prefer to have a low break even point, and a low break even point comes from having low fixed expenses. So just something to consider. So this balance of variable expenses versus fixed expenses, we need to think about if we really do want to take on another $15,000. What's our new break-even point? If we take our fixed expenses, do you remember how to compute break-even? We take fixed divided by our CM per unit. So if we take 95,000 divided by 180 CM per unit, our new break-even is now 527.77. So really 528 bikes is our break-even. Where under the original scenario, we break even by selling 400 bikes. So we're safe once we sell 400 bikes. Well, under this new scenario, it's pushing that break-even point way up, which that's a risk for a business owner to take on. So we'll continue exploring that idea of the risk that comes with greater fixed expenses. All right, try this one. So we want to reset. We've got our original scenario at 500 units. And what is the profit impact if RBC pays a $15 sales commission per bike sold instead of paying salespersons flat salaries that currently total $6,000 per month. So we're taking on more variable expense, right? A sales commission, that's on a per bike basis. So our variable expenses are going up $15 per unit, while our fixed expenses are going down by $6,000 per unit. And making this change, not $6,000 per unit, $6,000 per month, and this change is going to cause our unit sales to increase from 500 to 575. So let's think it through. If our variable expenses are going up by 15, so from 300 up to 315, what's happening to our CM per unit? It's going down, right? So variable expenses go up by 15 means our CM is going to go down by 15 to 185 instead of 200. So if we want to draw out our income statement, really we could just start right here with 575 units times 185 gives us 106,375, but they've done their sales minus variable equals contribution margin. And now our fixed expenses are lower by 6,000, and our net operating income is now up to 32,375. So if you're the business owner and you're thinking about this change, we've decreased our fixed expenses and taken on more variable expense per unit. What's our break even now? Can you figure it out? We take fixed expense divided by our CM per unit. What do you get? 74,000 divided by 185. Hey, I get 400. So our break even under this scenario is still 400 bikes. Maybe that's a little bit too textbooky, but if we think about making changes to our business, this change is generating plenty of net operating income without us taking on more risk of higher fixed expenses. So our break-even point stays the same. It looks like our net operating income is probably going to go up, and we're not necessarily taking on the risk of higher fixed expenses and higher break-even point. So to me, this seems like a good change to make. Let's try this one. If RBC has an opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers or fixed expenses, what price would it quote to the wholesaler if it wants to increase monthly profits by 3,000? That's a tricky one. So we're going to sell 150 bikes, and we want to increase our profit by 3,000. So I think we should probably take that 3,000 and divide it by 150 bikes. Just want to give you a moment to try to work this out. Pencil, paper, calculator. You can pause if you need to. So here's how we would solve it. We take the 3,000 divided by 150 bikes. That means we need to make a profit of $20 per bike. Well, to make a profit of $20 per bike, then our selling price has to be $20 over variable, meaning we need a CM per bike of 20. So sales minus variable is going to be our CM per unit. That's the $20 per bike. So working backwards, our selling price required is $320 per bike. And here they've shown the math to prove it. 150 bikes times 320 is 48,000. We subtract our variable costs. So again, our variable cost per bike is still 300 per bike times 150 is 45,000, which results in an increase to net operating income of 3,000. And take note, this has no bearing on our fixed expenses. We don't even factor that in. So we just know that we need to generate a CM per bike of $20. So that's quite a discount over what our normal selling price is, right? We need to be careful with doing that. If we're selling these bikes to a wholesaler at only $320 per bike, what's stopping them from flooding the market with these bikes priced at only $400 per bike? Well, we're trying to sell them at $500 per bike. So we need to be careful in selling these bikes to a wholesaler to make sure that they're not going to be competing with our prices. Maybe if they're in a completely different region, that might be okay. So our next task is to determine the break-even point. Well, wait, didn't we already do that way back at the beginning of the chapter? Yes, we did. So this should seem like review since we've already done this. They're going to teach us different ways of doing it, but we still know 400 bikes is our break-even. We took fixed divided by our CM per unit. So the equation and formula methods can be used to determine the unit sales and the dollar sales needed to achieve a target profit of 0. That's a different way of saying break even. Now, our target profit in real life, we're not ever going to really say, well, my target profit is 0. I just want to break even. But in terms of the math that we're doing, if we want to compute our break even point, that means a target profit of 0. All right, so we're going to use RBC again, and they've given us our per unit CM, and they've shown our CM ratios. And we already know that all we have to do is take fixed expenses divided by our CM per unit, and our break even is 400 bikes, right? Now, if we want to convert 400 bikes into sales dollars, how could we do that? What does a bike sell for? 400 bikes times $500 per unit. Our break even in sales dollars would be 200,000, right? So we can convert units into sales dollars, right? So I'm not totally convinced we need all these other methods of doing this. If we know it's 400 bikes and we know that they sell for $500 each, that's kind of the end of the story. But we'll humor them. Let's take a look. So the equation method, we're using the basic profit equation, and we already know this. So we've got profit, our target profit being 0, equals 200 times Q. So 200 CM per unit times the quantity, like parentheses there. That makes more sense, right? Order of operations, minus our fixed expenses. So how can we solve that? So we've got 0 equals 200 times Q minus fixed. We fill in what we know. We move the dollars to one side, and we've got 200 times Q equals 0 plus 80,000. So they're rearranging. They've moved the 200 and the Q to the left side and the 0 and the 80 to the other side. And we come up with Q equals 80,000 divided by 200. Wait, didn't we already know that? Isn't that what I said back here? 80,000 divided by 200. So doing this whole equation method got us right back to there. Yep, that's what we're learning here. So I'm not huge on the equation method. If we could just start with fixed divided by CM per unit, then just do that, and guess what we get? Of course, 400 bikes. Now, could we convert 400 units or 400 bikes into sales dollars? Sure. Multiply by the selling price, which was $500 per unit, and of course we get the same 200,000. How about using their formula method? Here's the formula method. The formula method is a shortcut version of the equation method. It centers on the idea discussed earlier in the chapter. So this is the formula. This is what I've been using all along. We know that fixed divided by CM equals our break even. So 80,000 divided by 200 equals 400. I'm pretty sure we learned that back on slide 6, and here we are on slide 52, but we're still right, 400 units, so good enough. But let's say RBC wants to compute sales dollars to break even rather than units. So here they give us a whole nother method of doing this. But you and I already know we can just take the 400 units and multiply it by our selling price per unit. But here's their math. So they're going to have us take the CM ratio, 40%, times sales minus fixed. And so now they're solving all of this. 0 equals 40% times sales minus 80,000. So again, we keep rearranging our equation. Now we got 40% times sales equals 80,000. So sales is going to equal 80,000 divided by 40%. So fixed divided by our CM ratio gives us our sales dollars. And again, that's still 400 bikes times $500 per unit. So they allow us to simplify that a bit into the formula method, which is our fixed expense divided by CM ratio. So if you want to go straight to dollars, you can do fixed divided by CM ratio. If you want it in units, you could do fixed divided by CM per unit. So either way works fine, gets you to the answer. How about you guys try this one? Pencil, paper, calculator, give this a shot. This is the same coffee clutch that we read about earlier. This time they want to know, an average of 2,100 cups are sold per month. Okay, that's old news. What is the break-even sales dollars? So you could compute it in units and convert that to sales dollars, or you can go straight to sales dollars, either way. So what is the break-even sales dollars? So we've got our fixed, and I think you guys already know the CM per unit. And I think you previously computed your CM ratio. So go ahead and solve it how you see fit. Hit pause while you solve it. And hopefully you came up with B, 1,715. Depending on how you solved it, you might be off by $1 or $2 due to rounding. But of these answer choices, that's definitely your best answer choice. So they took $1,300 fixed divided by the CM ratio that we actually computed previously, and they got 1715. And remember that CM ratio, that was $1.13 divided by $1.49. So the CM per unit is $1.13, right? That's $1.49 minus the variable expenses. So sales minus variable gave us $1.13. So my way of solving it, I would take 1,300 divided by $1.13, and I get 1,150 and some decimals. And then I would multiply that by my selling price, which is $1.49, and I come up with 1714. And I would still choose B. That's the closest answer, right? 1714.15. So I can't sell a partial, well, no. So it's still 1,150 units, which of course now I've ruined your next quick check. Now they want to know, what is the break-even sales in units? So you could take the 1715 and divide it by the selling price of $1.49. That's one way to do it. Or you could do the way I just did, which I took fixed divided by our CM per unit. And either way, you should still come up with, go ahead and pause if you need a minute to work your math. Should come up with D, 1,150 cups, and some decimals, but 1,150 would be the closest number. Did everybody do okay on those? Next, we're going to learn about our target profit. Determine the level of sales needed to achieve a desired target profit. Now, keeping in mind our break-even analysis, that's when our target profit was 0. So if we keep that in mind, that break-even analysis where we take fixed divided by our CM per unit, that means our target profit was 0. So we're going to look at our target profit analysis. Of course, they're going to give us too many methods to do it. We just need to know one method and know how to do it well under one method, but we'll work through that. So if we know that profit equals our unit CM times Q, the quantity, minus fixed, that's going to tell us our profit. So we can turn this into a target profit equation. So if we say that our target profit is 100,000, And that's going to equal our unit CM 200 times our unknown quantity, right? We're trying to figure out how many units we have to sell to achieve a certain target profit, minus our fixed of 80,000. Now we're solving for Q. And if you follow the math all the way through, we're moving the 80,000 to the other side. So we get 200 times Q equals 100,000 plus 80,000. So Q equals 180,000 divided by 200, and we get 900 units. So I don't love the way they're showing their work on their algebra here, but I also just don't love this equation method either. I prefer what they refer to as the formula method, which to me is much closer to our break-even analysis, thinking that under break-even, our target profit was 0. So under break-even, we're just taking fixed divided by our CM per unit because the target profit was 0. Well, now our target profit is going to be something else. In this case, it's going to be 100,000. So if we want to use the formula method, suppose RBC wants to know how many bikes must be sold to earn a profit of 100,000. So now we're going to take 100,000 target profit plus fixed, so 180,000 divided by 200 equals 900 units. So next they're going to teach us how to do all of this to compute our sales dollars. But I want to point out, if we know our units, what's our sales dollars to achieve a target profit of 100,000? Can't we just multiply this by 500? Wasn't that our selling price per unit? So 900 times 500, what do you get? 450,000, right? Okay, so keep that in mind as we move forward. So they're going to teach us what they think is a totally new concept. We can also compute the target profit in terms of sales dollars using either the equation or the formula method. And again, I think this is overkill. So here we go using the equation method. Profit equals CM ratio times sales minus fixed. So if our target profit is 100,000, we use our 40% CM ratio times sales minus 80,000. We're trying to solve for sales here. So we do our algebra. So they're taking the 40,000 times sales and moving that over to this side. And they're adding the 80,000 to the 100,000. So moving that to the other side. We get 40% times sales equals 180,000. So then we divide both sides by 40%. So we get sales equals 180,000 divided by 40%, which mathematically works out to 450,000. But we already knew that. And then the formula method that they're about to show us really just picks up right here. It's just these last two lines. The formula is target profit plus fixed divided by our CM ratio. So 180,000 on top divided by 40% gives us the same dollar sales, 450,000. But again, that's old news. If you knew how to compute your target profit, your units required to achieve a target profit, you can just multiply those units times the selling price per unit. How about you give it a try with Coffee Klatch? Now, I really don't care which method you use whichever method you prefer. So they want to know how many cups of coffee would have to be sold to attain a target profit of $2,500 per month. Go ahead and hit pause while you work this out. Pencil, paper, calculator. See if you can solve this problem. All right, what did you get? I'm hoping you came up with answer A. So we can take our target profit plus fixed, so $2,500 target profit plus $1,300 of fixed expenses, so that's $3,800 on top, and we divide it by our unit CM. So we already had computed that, $1.49 minus 36 cents is $1.13. So if we take $3,800 divided by $1.13, we need to sell 3,363 cups to achieve a target profit of $2,500. Could we convert that into our sales dollars? Do we need to start over entirely to do that? I wouldn't. I would just take the 3,363 cups times $1.49 per cup. That would be my gut. So try quick check 5. You can solve it however you want. Again, they tell you to use the formula method. Hit pause while you do your math here. All right, and I'm hoping that you guys came up with answer B. So we're taking, again, our target profit plus fixed, that's 3,800 on top, and dividing by, if we do it their way, the CM ratio, which we computed that a while back, right? We already knew our CM ratio to be 0.758. Then we should come up with sales dollars of 5,113. But I still go back to the other way. Couldn't I also do that by taking 3,363 cups times $1.49, and I come up, I'm off by a couple dollars. I get 5,010 and 87 cents, and that's just as good of an answer. Theirs is actually off from mine in that they've rounded. So both answers would be just fine, especially in a multiple choice environment. I think you're still going to choose answer B here. Our next concept is margin of safety. We need to learn how to compute the margin of safety and explain its significance. So why would we need to know this? Why is this important to the business owner or the business manager? So the margin of safety can be computed in dollars and in units. So we're going to look at dollars first. And what this is, the margin of safety is the excess of budgeted or actual sales dollars over break even. So we're comparing either our budget or even our actual sales dollars to our break even point. We're just looking at how much did we exceed break even. So again, margin of safety, the concept is by how much did we exceed break even. All right, so another way to look at too is it is the amount by which sales could drop before losses are incurred. So in order to stay safe, it's the amount by which sales could drop before losses are incurred. So that's what's keeping us safe, is that margin of safety. The higher the margin of safety, the lower the risk of not breaking even and incurring a loss. So looking at RBC, our break even we know is 400 bikes, right? We learned that a long time ago. And if we compare that to our actual sales, 400 units versus 500 units, or we compare our sales dollars, 200,000 versus 250,000, we have a margin of safety of $50,000. We could also say that we have a margin of safety of 100 units. Okay, we can also express our margin of safety as a percentage, and we take that by dividing the margin of safety in dollars by the total dollars. Okay, and this is critical that we're using the right dollars. So we're taking the $50,000 margin of safety and we're dividing it by the actual, okay? Not the break even. We're dividing it by the actual and we get 20%. You would get the wrong answer if you take 50,000 divided by 200,000. So we're taking 50,000 divided by 250,000. We should come up with a margin of safety of 20%. And again, we can also do this in units. We can take those $50,000 margin of safety in dollars, 50,000, and divide it by 500 sales dollars per unit equals 100 bikes. But I'm pretty sure that we could see that all the way back here. 400 bikes versus 500 bikes. We've exceeded the margin of safety by 100 bikes. So I'm not quite sure why we have to do math in order to get 100 bikes. But there you have it. So let's try this at Coffee Clatch. It's your turn. Get out your pencil, paper, and calculator. See if you can work this out. What is the margin of safety expressed in cups? Margin of safety expressed in cups. So they're telling you what their average is, and you want to compare that to their break-even level. Go ahead and hit pause while you work this problem. This one is a little bit harder, right? All right, what did you get? I'm hoping you picked B. So our margin of safety, we take our total sales, so this time in units, 2,100 cups. versus our break-even sales. Hopefully you remembered that from a previous problem that we already worked, right? 2,100 cups minus 1,100 cups of break-even sales equals 950 cups. Now, if you didn't remember the break-even, you had a little bit of math to do there, right? So we get 950 cups. Could we also express that in dollars? Sure, we could take 950 cups times $1.49, and then we'd have our margin of safety in sales dollars. Cost structure and profit stability. This is what I was referring to earlier. Our relative proportion of fixed and variable costs say something about the company's cost structure and what we refer to as profit stability, or even the risk that we're taking on. So in general, when we have higher fixed costs versus variable costs, we're taking on more risk. Now, with risk also comes reward. So a high fixed cost structure results in less profit stability. Now, we're going to see more reward when things are really good. We're going to make more money, but when things are bad, we're going to lose more money. So I know you can't see me, but if you're thinking of a pendulum swinging, a high fixed cost structure, the pendulum is swinging really high. So if we're thinking of a pendulum, you know what a pendulum is, right? So let's say this pendulum, it's going to swing really high when we have a high fixed cost structure. So our pendulum swings really high, okay? Now, if we have a higher amount of variable expenses versus fixed, our break-even point's going to go down. We have to sell less units just to break even. So this pendulum, my pendulums are really ugly, right? That's okay. I can handle it. In a high variable cost structure, now there's not as much risk, and therefore there's not as much reward. So our pendulum's just going to swing right here. So it's much more safe, much more stable. But we're also not going to be rewarded with massive profits in a good year. But we also don't have to fear the massive losses in a really bad year. If you think of opening up a new business, let's say that you're going to walk away from your job and open up a new business. The safest thing to do is to open up a business that has low overhead, low fixed costs. You don't have to spend a fortune on, monthly rent and insurance and all these big fixed costs, because as a new company, it's hard to generate enough contribution margin to cover all of that. So a lot of times the easiest businesses to start are those with high variable costs and low fixed costs. Fixed costs are essentially a barrier to entry. So I find this is too many words on the screen and a little bit confusing, but stick with me. The book's saying the same thing I am. There are advantages and disadvantages to high fixed costs or low variable costs versus low fixed costs and high variable cost structures, right? So if our fixed costs are relatively high, that would imply that our variable costs are relatively low, and vice versa. When we have low fixed costs, we have high variable costs. Okay, so that's the relative proportion in terms of our overall expenses. So the advantage of high fixed costs is that income will be higher in good years compared to companies with a lower proportion of fixed costs. The disadvantage, though, is that high fixed cost structure is that income will be lower in bad years compared to companies with lower proportion of fixed costs. So we're talking about the pendulum swinging high. That's what we're looking at here. The pendulum swings back and forth really high. So less stable, but it comes with more risk and more reward. Companies with low fixed cost structures enjoy greater stability in income across good and bad years. So going back to the pendulums, so this would be high fixed costs is when the pendulum swings high, versus high variable costs is where the pendulum swings low. So less risk, but also less reward. Degree of operating leverage. So degree of operating leverage is a new concept. So operating leverage is the measure of how sensitive net operating income is to changes in sales. So it's a measure at any given level of sales of how a percentage change in sales volume will affect our profits. So we're going to take our contribution margin and divide it by our net operating income. And this could be at any level of sales. So if we're looking at RBC, we're going to take our contribution margin, 100,000, divided by our net income, 20,000. So we get 100,000 divided by 20. Our degree of operating leverage equals 5. 5 what? Well, that's the trick. We need to know how this applies to us. So what this is saying, with an operating leverage of 5, if RBC increases sales by 10%, net operating income is going to increase by 5 times that amount, 50%, right? 10% times 5 is 50%. So here they're proving it mathematically. So if sales go from 500 units up 10% up to 550 units, we see our sales go up by 10%, variable goes up by 10%. Really, we could just start here, right? Our CM goes from 100,000 up to 110,000. While fixed costs stay the same, our net operating income is increasing by 50% from 20,000 up to 30,000. So that's a 50% increase in our net operating income. So that's how we can use the degree of operating leverage to solve problems as well. All right, it's your turn to try this with Coffee Klatch. Pencil, paper, calculator. What is the operating leverage at Coffee Klatch? Do you remember the formula? We're going to take our contribution margin in dollars divided by our net income in dollars, so total dollars. So we've got 2,373. How did we get that? Well, that's at 2,100 cups, right? So we've got sales minus variable, we get 2,373, and we're going to divide it by our net operating income of 1,073, and we get a degree of operating leverage of 2.21. So how about this? If sales increase by 20%, by how much should net operating income then increase? What was that degree of operating leverage again? 2.21. Do we even need a calculator to choose the right answer here? 20% times degree of operating leverage, 2.21. Hopefully you came up with D. So 20% times 2.21, you should have come up with 44.2%, which clearly answer D is the best choice then. And we can verify all of that. We can do all the math if you want to see it. So if we increase our sales from 2,100 cups up 20%, goes up to 2,520. We do all of our math and we see that our net operating income goes from 1,073 up to 1,548. So if I take 1,073 times 1.442, I get that same answer, 1,548. Sales commissions. So a lot of companies generally compensate their salespeople by paying them either a commission based on sales or a salary plus amount of sales commission. Commissions based on sales dollars, however, could potentially lead to lower profits depending on how we structure it, which what I'm saying is we need to be smart in how we're structuring it, making sure that we're motivating our salespeople to sell the right products. So they give us this example. Pipeline Unlimited produces 2 types of surfboards, the XR7 and the Turbo. The Turbo sells for $100 and generates a CM per unit of $25. The Turbo sells for $150 and earns a CM per unit of $18. So if the sales force at Pipeline Unlimited is compensated based on sales commission, which of these are you going to want to sell? If you're a salesperson and you're being compensated on sales commissions, and that sales commission is computed based on sales dollars, which surfboard are you going to try to push? The XR7 or the Turbo? We're going to try to sell the Turbo, right? Because we're going to make more money. Our commission's going to be higher if we sell the more expensive product. But is that really a good idea? If you were on the sales force at Pipeline, you would probably be pushing hard to sell the Turbo, even though the XR7 earns a higher contribution margin per unit. To eliminate this type of conflict, commissions can be based on CM rather than on selling price alone. So if they changed their commission structure, said, no, it's not based on sales dollars, you're going to receive a commission based on how much contribution margin you bring into the company. Now, which unit are you trying to sell? Now you'd be focused on selling the XR7, which would be more profitable for the company. Break-even point in a multi-product company. Oh boy. So this can be complex. First, we need to understand the idea of sales mix. And sales mix is the relative proportion in which a company's products are sold. So different products potentially have different selling prices, cost structures, and contribution margins. So when a company sells more than one product, break-even analysis becomes more complex. So let's take a look at RBC again. But let's say that RBC doesn't just sell one type of bicycles, they also sell carts. So what we find out is that bikes comprise 45% of RBC's sales revenue, and the carts comprise the other 55%. Okay, so bikes make up 45% and carts are 55%. And we're computing that, taking the $250,000 out of $550,000 of sales versus $300,000 out of $550,000. So that's where these percentages are coming from. That's our current sales mix. So they've done all the math here showing our sales, variable, and contribution margin at this sales mix. And we find out that we've got a contribution margin percentage of 48.2%. So they're getting that by taking $265,000 contribution margin divided by $550,000 in sales. So our CM ratio is 48.2%. Now that's useful, but it's honestly only useful at this sales mix. So our dollar sales to break even, we can take our fixed expenses. So if we add up our total fixed expenses, which are $170,000, and we divide it out by our CM ratio, 48.2%, in order to break even, we need to have $352,697 in sales. So we're backing into this figure. Okay, so we've totally just backed into this number. So based on $352,697 in sales, carts still have to be 55% of that. So we're working our math backwards here. $352,697 times 55% gives us $193,983. $352,697 times 45% gives us $158,714. So we worked this whole line backwards to figure out the sales of each type of product. And then we compute our variable expenses and CM based on the ratios that we already had. So we get the sales first, and then we figure out our variable and CM based on the ratios we already had. So we do all this work, we get $170,176 minus fixed expenses of $170,000, and we end up with $176. Honestly, that's rounding error, which I know that sounds like a lot of rounding error, but this is about as close as we can get to break even in this multi-product environment. But keeping in mind that this analysis is only valid at this sales mix being 45% and 55%. If that mix changes at all, then our break-even point changes as well. That is the end of the body of Chapter 5. We do still have to cover the appendix of Chapter 5, so we do need to cover Chapter 5A. Keep watching and click on the video for Chapter 5A for some more important chapter content. Thanks, you guys. I'll see you soon.